Hi everyone, it's Grace. Welcome back to my channel. So 2021 is almost over and has been quite a roller coaster ride this year. So the inflation rate just went up to 6.2%, marking the highest level in 30 years. This is really bad news. Contrary to what the Fed says, high inflation is definitely here to stay. So today we're going to see why the inflation rate will continue to go even higher and we're heading to an economic depression in 2022. Before we begin, remember to subscribe to my channel and click on the bell button so you'll get notified immediately when new videos are uploaded. Also, feel free to give this video a thumbs up if you find it useful. So another news just came this Monday that Jerome Powell will be renominated for another 4-year term, which basically means that the federal funds rate will not be increased anytime soon, despite the obvious fact that the inflation rate is totally getting out of control. I did 2 polls last week asking you whether the inflation rate will go above 10% and whether the Fed will increase the federal funds rate before or after it hits 10%. 72% say that the inflation rate will go above 10% next year, and 55% of you say that the Fed will wait until it hits the 10% mark to increase the federal funds rate. I have to say that I agree with the majority vote, and the news basically just reaffirms this because Powell is very hawkish in terms of monetary policy. We all know that high inflation will erode economic development, but the renomination basically means that the government allows the inflation rate to go even higher. And here are 4 reasons why I think it will ultimately lead to an economic depression in 2022. Number 1, the government is asking oil companies to curb the oil prices, and the next method is probably price control. Biden is asking OPEC to increase supply and reduce the oil price, which is what's pulling up the average inflation rate. It's also an attempt to decrease the inflation rate without increasing the federal funds rate. We'll probably see price control kicking in sometime next year as inflation goes even higher, which will provide a temporary relief until it goes through the roof. Remember that Nixon passed the Economic Stabilization Act of 1970 to freeze wage and price for 90 days from 1971 to 74. But it didn't work, and inflation rate went up to 12%. We are repeating the exact same mistake in the 1970s. Price control doesn't work. It has never worked before. But the government will probably still do it. Number 2. Labor force participation rate is the lowest in more than 20 years. Another thing you should pay attention to is the labor force participation rate, which is different from the unemployment rate. The priority of the Fed is to keep low unemployment and low inflation, and the market is very sensitive to these 2 numbers. While the unemployment rate continued to drop to 4.6% in October 2021, we have the lowest labor force participation rate in history at 61.6%. So if you count the number of people currently active in the labor force, of course the unemployment rate is going to drop. But this is not what a healthy and productive economy should look like. If we're talking about a 90% labor force participation rate and a 4.6 unemployment rate, then we don't have a problem. On the contrary, we're heading to a depression that's even greater and more catastrophic than before. Here's why labor force participation rate is more important than unemployment rate. The high labor cost is killing small business. They have to give up revenues that could have been used to continue and expand business, but because of hiking labor cost, more small businesses are forced to close. Number 3, the infrastructure bill is passed at the worst time possible, and it increases the national debt. Don't get me wrong, the $1.2 trillion bill is necessary to fix and update the existing infrastructure, which will also help the economy. But it will also add to the national deficit, which is currently at over $28 trillion. I made a video before about the national debt and the debt ceiling. You can click here to check out that video. Another $2.3 trillion is on the way to being passed as well. But some of the items in the bill has nothing to do with infrastructure, so I question whether it's necessary to add that extra amount. One way to see the infrastructure bill's impact on the national debt is by looking at the debt to GDP ratio. Currently, the ratio is at 125%, which means that the current productivity level is not nearly enough to cover the national debt. In my honest opinion, I think the timing of the infrastructure bill being passed and the skyrocketing inflation rate is a bad combination. Right now, the inflation rate is at 6.2%, which makes production worse. given that more than 4.4 million Americans quit their jobs. So how is the supply going to keep up with the demand and boost the GDP? Number 4, the wealth tax proposal will contribute to a longer economic depression. The wealth tax proposal will soon take into effect, and we may experience an economic depression sooner than expected. I understand the wealth tax is necessary to fund the infrastructure bill, but the intended result of a policy is usually different from the actual result. Let's take a look at the original proposal in the Bill of American Families Plan. The president will be proposing a set of measures to make sure that the wealthiest Americans pay their share in taxes, while ensuring that no one making $400,000 per year or less will see their taxes go up. When combined with President Biden's American Jobs Plan, this legislation will be fully paid for over 15 years and will reduce deficits over the long term. So what it means is that the wealth tax will be implemented to fund the $1.2 trillion bill and any extra amount. It also explains why Elon Musk sold more than $9 billion worth of Tesla stocks, not only because the maturity date of his stock options was coming up, but also because it's a rational business decision. To explain the new tax rate, I'll be using the example from Tax Foundation, which provides a standard $100 million worth of assets. The first wealth tax is the capital gains taxes on unrealized assets over $1 million upon death. Unrealized means that any assets that are not sold will be taxed upon death. The second wealth tax is to increase the capital gains taxes on millionaires to 39.6%. The third wealth tax is a estate tax of 40% above the exemption level of 11.7 million, which means that both capital gains taxes and estate taxes are imposed on the same asset. All these three taxes will increase the tax rate at a whopping 61.1%. In comparison, the current long-term capital gains taxes when assets are realized or sold is at 23.8%. That includes regular long-term capital gains taxes and net investment income tax. So given these two options, it makes sense for him to sell the stocks and pay a tax rate at 23.8% versus holding them and pay a 61.1% tax rate. It's just a simple mathematical comparison and not hard to figure out. So the actual result of the wealth tax proposal is that the rich will start selling assets and pay at a lower tax rate now versus paying at a rate that's 2 to 3 times more when the proposal takes into effect. So this will cause the rich to start selling assets and pop the asset bubble. But here's the side effect of the wealth tax. It doesn't mean that the rich will actually be taxed at 61.1%. It simply means that they choose to offload assets now, perhaps just enough to pay for the infrastructure bill, however much it is, for as long as the wealth tax is still in place. But if the wealth tax goes away, the portion of the taxes that the rich has already paid for will probably find its way back to regular people, which means that the tax rate will increase for everyone nonetheless. An increasing tax rate will reduce savings and discourage investment and drag the economy longer in depression. So this is today's video about why the inflation rate will go even higher in 2022 and why we're heading to an economic depression. What do you think? Comment down in the section below and let me know. As always, thank you very much for watching, and I'll see you on the next one.